We have Prakash Diwan joining us. Prakash, hi, good afternoon. Thanks a lot for joining us. Been a very strong day for the market, of course. Reliance has led it. But, there's one school of thought which believes that perhaps today's rally could be an exit opportunity in names like Reliance. Given that, you still have the uncertainty on tax and in any case, the GRMs are moderated. But leave that aside. You have the numbers coming up, the AGM coming up. How would you approach this big boy?
So, historically, Anuj, what happens is Reliance has always, post the numbers, it's kind of reacted and it's seen some sort of profit booking come in. And I would rule that out even this time around. While very clearly earnings are likely to be extremely strong, extremely spectacular, given that it's been, firing on all cylinders. My sense is that we will probably have to look at those earnings and probably give it a week after the earnings for consolidation, and then the next big move could begin. But at this point in time, yes, I would be averse to recommending booking a profit for somebody who's made this quick money in the last because remember it's a very short-term news flow driven thing. The fundamentals haven't changed dramatically either ways, good or bad. But it will need a few more triggers to really go back to those previous highs, and there's still some time for that.
Okay, I think results this Friday, and then the AGM for the company coming Wednesday, that is the 27th. So there are, a bunch of triggers lined up as well. Away from purely, of course, the refining business for the company as a whole, the AGM, of course, is an important event in the calendar, annual calendar, as far as Reliance is concerned. Prakash, hi, afternoon. Any thoughts on the FMCG space after HUL numbers? A lot of debate about what HUL numbers really imply as far as volume growth going ahead is concerned, and the fact that maybe it's not as rosy. We had Dabur, speaking to media sometime back, painting a pretty tough picture as far as rural demand is concerned. And yesterday, my colleague Shilpa spoke with the Godrej Consumer, the MD, who said exactly the same thing. He said, people are sort of moving away from discretionary consumption. They want to save more. And also the fact that instead of premiumization, they are focused on sort of coming up with products to serve the bottom of the pyramid. It's quite telling, isn't it? Your sense?
Good afternoon, Prashant. So I do accept the fact that, FMCG, all names are undergoing a severe stress on the input side, on the cost side. But remember, the other thing that has happened in the last 3-4 months primarily is that while everybody was anticipating this inflationary impact, larger efficient companies have actually done enough belt tightening in terms of the other processes or other elements of the process, whether it's packaging, whether it's distribution, freight, repackaging, the grammage. So a lot of those things have happened, and that's exactly why you still have volume growth coming even in this tepid market. Now, what's going to be interesting is that everybody is anticipating a slowdown, and in preparation of that slowdown, there are lots of things that have already got in place in terms of cost controls and rationalization of products and the mix itself. But when the numbers finally happen after 2 quarters, I would be surprised if we had a regular monsoon, if the harvest is decent enough, if the pricing of most agri commodities is where it is. There could be a huge percolating effect, a downstream percolation of all the benefits to the rural spenders, and there could be so an HUL might not see great stuff being sold on, let's say, the Dow portfolio, but there's enough and more that they have on the low price point on the lower end of the segment. That's where it could actually make up. So volumes will come from there. The margins could probably still be under a little bit of stress, but I don't see it's something which is going to be very long lasting unless there's a dramatic increase in inflation and affordability just quits out of the window. But till then, I think all these companies have enough products in their portfolios to survive the slowdown and then get out of it very strong. So and people buy, institutional investors love to buy these stocks in anticipation how the next 4-8 quarters are going to be, not just the next 1 quarter. So mind you, that's where they are poised, and it could offer you a very good entry point at some point in time from between now and the September earnings.
Okay, all right. Prakash, noted that one on FMCG, but let's spice things up. Let's talk about Metal Pack and let's talk about Vedanta. First, I'll just run you through the top 3 points why the stock is getting today. They've declared their second interim dividend and they've declared 19 rupees 50 paise. Remember, the street was bracing for this because Hindustan Zinc paid out a good dividend, and if you translate that to Vedanta shareholders, they should have been paying out close to 15 rupees 50 paise. Well, they've declared a dividend that's higher than that, 4 rupees higher than that, so the street was happy. And you put together the last dividend as well as this one, that's the 19 rupees 50 paise. They've already declared close to 51 rupees per share in this year. So splendid stuff out there. Then the windfall tax reduction. It's been reduced around 17,000 from around 23,250 odd. What that entails is the windfall tax, it translates to close to $29 per ton per barrel in comparison to around $40 per barrel. So that's a sharp reduction out there. And Phillip Capital says that this will add close to 2% to the consolidated EBITDA. And the third factor is the dollar, it's cooled down from around that 108.5 odd to around 107. When that normally happens, you see commodities do well, which in turn is reflecting in Vedanta share price as well. Prakash, what do you do with the stock? It's very, very difficult to predict it. I'm just looking at a couple of data points. If someone bought the stock in November 2020, the dividend that they've received till now is around 95, 96 rupees.
95.
Yeah. And the stock price at that time was 94, 95 rupees odd. So they have got back all their money via dividends. And guess what? They're sitting on a stock worth 250 rupees. But difficult to time this one, difficult to say what the promoter intent is. What do you do with it at around 250 rupees?
Yes, Nigel, good afternoon. I agree. It's not an easy play because the promoter has, the management has its own whims and fancies around this business. And it's a complex, this business of so many moving parts in terms of, the underlying revenue streams. But what's interesting is that, and we spoke about this about a week back when Hindustan Zinc was to announce that blockbuster dividend, whether Vedanta is going to pass through the entire $15 or whatever was calculated. And it did. In fact, it's done a bit more than that. Now, the reason why it's down and out was because people were not too sure whether the management would probably be as generous as they've been in the previous year in terms of collecting dividends out of the company. But the parent still needs to clear off a lot of debt. Vedanta PLC has to repair its balance sheet, and any money coming in from the Indian business was more than welcome. So I think that's what's happened. Whoever has gone with that line of thought is probably benefited. Now you probably have already, let's say, $50 of the dividend play moving out. You could probably have a residual dividend of about 50, 20 rupees in the next 12 months or the 9 months. But there is still appreciation that's possible. The capital gains that you could make on Vedanta as commodities rev up and things look up is fairly significant. So I would rule it out. Remember, it's almost come down from those 430 zones. So you still have some sort of a headroom in terms of the appreciation. But yes, it's a high beta name. Take it with a pinch of salt. You can only take it once your core portfolio is in place and you're just topping it with some high risk, high reward kind of plays. But otherwise, I think it's fairly constructive at this point.
Okay, well, let's now address the sector of the day, and that's IT. Midcap IT in particular has been seeing some good gains. From the recent lows, some of these stocks are now up between 8 to 10%. Of course, before that, we had a big fall as well. Rima is here to tell us what's happening here. Rima, hi.
Hi, thanks so much for that. Well, this week itself, in the last 3 days, mid-cap IT names like LTI, Mindtree, Persistent, Happiest Minds have all seen a rally of close to about 10%. So there is a short covering up move that you are seeing there. And we're going to get a slew of mid-cap IT earnings from today to Friday, close to about 7 to 8 of them. So today, Wipro and Mastech will be reporting numbers. Tomorrow, you've got Sign, Happiest Minds, IndiaMart, Emphasis, as well as Persistent. And then on Friday, Coforge will be reporting numbers. And we've been talking about how Infi will be reporting numbers on Sunday. So by the end of this week, we will definitely have a much clearer picture. Now, talking about the big ones, which will come out today on the mid-cap end, it's going to be Emphasis, Scient, as well as Persistent. So from Emphasis, which predominantly gets 50% of its revenues from the banking and financial vertical, what will the street watch very closely? Well, rising interest rates in the US is typically negative for the mortgage business, where Emphasis derives some of the business. So management commentary surrounding that will be very crucial. Persistent is expected to report a very strong revenue growth of close to about 10%, and that is aided by 2 acquisitions that they did, which will contribute about 5% to the top line. For Scient, it's expected to be a muted top line growth of 1.5%, but margins are likely to come under pressure owing to wage hikes. So these would be the key things to watch from the mid-cap IT earnings this week. Back to you.
Okay, Rima, thank you very much for that. Prakash, your thoughts? I mean, we're seeing pretty large moves. The third day of the week, but in many cases, stocks are up 13, 14%. I mean, top gainers are mid caps, the larger ones, Wipro, Infosys, TCS, etc., of course, lower down, but still meaningful moves.
Yes, Prashant. So, I think as Rima pointed out, not only short covering has been a big push, it's also, the likelihood of inflation topping out in the US and hence interest rates probably not. I mean, there's a little bit of a visibility in terms of the hikes that you could probably expect from the US Fed. And once that's kind of factored in, the fear of losing contracts or contraction of the demand side itself for some of these companies, which was big when TCS came up with numbers and we saw the kind of pressure on margins, that kind of was a bit overdone. So the market just kind of correcting itself on that expectation. Remember, mid-cap companies have a slightly edge in terms of not having to weigh down too much on margins and contract sizes because they really don't have to depend on a very significant large contracts to come their way all the time. And from that perspective, some of them like Happiest Minds and all, which had actually got beaten down because of the given, pressure on the sector as a whole, they are the ones that are kind of bouncing back. Now it's of course up to earnings, where earnings take these and what kind of traction you could see, visibility you could see. But remember, the multiples are still not on the cheap side, Prashant. So, IT is good because it's a bounce back, but don't kind of read too much into it that this is going to be a turning point and they're going to go back to the highs very quickly. I think it's still some time away. The structural story is still to kind of come back in their favor, but it'll be in fits and starts. You'll probably see a little bit of revival for sure. So I would be very watchful of buying into it now. You could have bought a Tech Mahindra at sub 1,000 levels and enjoy that 8-10% that you've seen. But it's difficult to kind of time it perfectly. But I would not buy with that conviction as yet. We'll still wait for some maybe another quarter for the larger players to start reporting improved numbers, and then things could look different.